Welcome back to the channel and to another video. Today guys, I'm excited because we're going to be analysing a long-awaited stock on this channel. I've had tons of requests to cover it, and in my opinion, it is truly one of the best and most powerful businesses in the world today. The company we're going to be covering for both a full review of the business and intrinsic valuation is Tencent. Tencent can be found under either the ticker symbol TCEHY for the over-the-counter markets to get the ADR, or through the Hong Kong Stock Exchange if you have access to that. Now, the plan today is to give you some insight into Tencent's business model, how it operates, because it is quite a complicated business, and then address how attractive the stock price is today through creating a valuation and then measuring it against its peers. Tencent is the 7th most valuable company in the world by market cap, with a value of over 770 billion, making it the biggest in China and Asia, and bigger than its fierce rival Alibaba. The story and rise of Tencent is one of the most intriguing and impressive business stories to date, so I would recommend doing some research on that yourself if you're interested, because we won't have time to cover it all today. But in short, if you bought a small amount of Tencent at its IPO in 2004, well, you would probably be either a millionaire or even a billionaire today. That's because it's had one of the biggest and longest run-ups in stock market history, boasting a 75,000% return since just 2004. That means your $10,000 investment back in 2004 would be worth over $7.5 million after just 16 years today. Now, if you're as fascinated by these stories as I am, I'd go and check out the Naspers story, where they invested very early into Tencent and have held that stock position throughout the years. Now I think that position's worth around 300 billion. They own close to 30% of the company. So I'd suggest going and studying that investment. And if we can learn something out of it and reverse engineer it, then maybe we will all be billionaires sometime soon. But moving on, let's look at Tencent's business. And they're truly a conglomerate in the best sense. This is because Tencent is mainly an investment holdings company that houses some of the best domestic Chinese brands and businesses under its banner, as well as holding a equity investment portfolio worth over $300 billion. They have huge percentage stakes in some of the biggest and most fast-growing companies in the world, the likes of Tesla, Snapchat, Sea Limited, Spotify, JD.com, and Pinduoduo. And in my mind, it has some very big similarities to the likes of Berkshire Hathaway in the States, just with more growth and forward-thinking aspect to their business and capital allocation. But we'll touch on their investment portfolio a bit later. But first, I want to look more at their operating businesses and just appreciate Tencent's dominance and how good of a business this really is. A lot of you won't be familiar with these applications because they're used in China, but I'll try to break it down as best as I can. So Tencent's aim is essentially to build a digital ecosystem that fulfills all areas of a consumer's needs on a daily basis. And you can see here they do just that. Everything a consumer would need is in one place, from socializing and communicating to making payments for goods to watching videos or listening to audio and also playing games. The crazy part is this vast ecosystem is housed under mainly just one app. Now, internationally, we know this app as WeChat, but in China, it's Weixin. Essentially, WeChat is what we'll refer to it as, gives you everything you need in one app and in instantaneous fashion as well. Just think of Google Search, YouTube, Facebook, Netflix, Apple Pay, and a game store all being under one app, owned by one company. Now, all of this has led to Tencent being arguably the most dominant digital player in China, especially if you look at the industries that they serve. Demonstrated nicely in this flywheel fashion here, their integrated business that mostly starts with either the WeChat or QQ apps has allowed them to be a number one player in social media, gaming, video and music, mobile payments, and mobile search. The only industry that they're in that they place second in is cloud, where they lose out to tech giant Alibaba. But it's very, very rare to see this kind of dominance in so many fields. I mean, just look at the number of monthly active users for WeChat, their core ecosystem app. 1.24 billion monthly active users. That's almost 4 times the US population, and it's a 90% penetration of the entire Chinese population. So this is a very dominant company in a very big market. This sort of user count is so powerful for a technology company like Tencent that leverages the user data. It gets to grow its core business and allocate capital in the most effective way. Now, getting over to the financials of this business, we can see most of their revenue comes from what they call value-added services, which is the games part of the business. This is mobile games, PC games, console games. They own a ton of games companies and are the preferred publisher for very popular mobile games. A few notable mentions would be Call of Duty, FIFA Online, NBA Online, as well as owning the titles for Honor of Kings, League of Legends, Clash of Clans, Call of Duty Mobile, and many other popular games as well. So this gaming value-added services part of the business makes up 32%. This is probably coming from in-game purchases and things like that, or premium content. The other part of value-added services is these social networks. Again, probably premium services and memberships through their social networking sites and one-off item sales. So together, this makes up around 54% of the business's revenue. Next, we have online advertising, which makes up 17% of the revenue. This comes from online and digital ads through their social platforms and media platforms. And then lastly, 20% comes from the fintech and cloud part of the business, which is the over 1 billion daily payments. That's right, 1 billion daily payments on WeChat Pay and their fast-growing cloud services business. We do have 2% of revenue which comes from others. It isn't allocated to any operating segment, but is pretty meaningless at this point. We can see revenue is very well diversified, majority of it coming from the gaming portion of the business, but fintech and cloud making up a very sizable portion, online ads as well, and then the social networking side making up over a fifth of the business. And the revenue growth over the past 5 years has been somewhat extraordinary for such a big company. They've boasted a 5-year compound annual growth rate of 33%. Not many companies of this size have been able to do the same. And the bottom line for this company has been just as exciting and just as expansive. They've got 38% EBITDA margins, which is best in class, and then free cash flow growth has been 39% compounded for the past 5 years, which beats the top line. Always a good thing to see. And we will touch on the financials again as we get to the valuation part of the video. We'll have it up on the spreadsheet because a lot of what they show on the annual report is in RMB, so it's not that helpful. But what I do want to touch on is the Tencent Holdings portfolio, the $300 billion portfolio of equity holdings that this company has that I mentioned earlier in the video. Now, shout out to Packy McCormick from the Not Boring podcast. Go ahead and check that out. He did a really interesting podcast on Tencent where he also included this spreadsheet, which must have taken him quite a long time to put together. So it's got around 100 of Tencent's 700 plus equity portfolio, but this has got the largest ones. So it probably gives us an idea of how much it's worth. He's got 314 billion as the current value. Of course, the majority of these are public stocks, so we can actually track their market value with the likes of C Limited, JD.com, Pinduoduo, Tesla, Tencent Music, Snapchat, and Spotify, and many others. But we also have private companies that they hold big stakes in, the likes of Riot Games, the big video game developer and publisher, Epic Games, Universal Music Group, which actually he's given a $33.6 billion value. We know as of today they're valuing that business over $40 billion because it's set to merge with Bill Ackman's SPAC. So there's going to be some give or take in the value of these holdings, but I think he's done a very good job in valuing all of these equity stakes for us. Now, 314 billion, I want you to remember that because we are going to take that into the valuation. We may discount it slightly to be on the conservative side, but we're going to add it in as an additional point of equity to see what sort of value we should be placing on this business. Okay, now we are going to jump in to the valuation. I'll see what sort of price we should be paying maybe for Tencent or how good value the stock is today. Last little thing though I want to look at is really the characteristics which sum up Tencent and why it's such a good business, why I like a business like Tencent, and it's in their cash flow statement. So when I was doing some research on the business here, I came across obviously its cash flow statement and really the way in which it reinvests capital back into its business from its core operating businesses is what's leading to its long-lasting and fast-paced growth. So we look here, they've got cash from operations, so in the billions, this is all in US dollars converted from RMB. So we can see they've always been profitable, always had margins over 20 to 30% on the net income side, Cash from operations, 7 billion all the way up to 29 billion today. But it's the money that they invest back into the business that impresses me. Only 5 billion, obviously, at the moment in capital expenditures, 5 billion last year as well. But everything else, every extra penny they have is reinvested back into the business. Okay, they spend a little bit of money on capex, but not a huge amount relative to the cash from operations. 5 billion this year. No property, plant and equipment, no real estate properties, nothing needed for that. Everything is just cash acquisitions, purchase of intangible assets, which is essentially just brands, and then investments into the marketable and equity securities. 16 billion into the market and equitable securities portfolio that they had. That's a huge amount. So cash from investing minus 28 billion. That means out of the 29 billion that they received in operations, they've reinvested all of that back into the business. And that is what leads to compounding. That's why this business has been able to compound so quickly and so effectively for the past 16 years. That's why the stock has gone where it has. And it's definitely one of the reasons why they do have more debt than cash on their balance sheet, because they don't hold cash. They find something to do with it, which is obviously a good thing, can be a bad thing sometimes as well. But I just thought I'd show you guys the cash flow statement, because it really does tell you all you need to know about their capital allocation strategy and their business model in general. Right, so back to the valuation. I've done a 5-year forecast for Tencent. We've looked over the financials already, as you can see, but you can pause the video if you want to digest any of this, digest any of the averages. Very positive historical results, very good performance. We're going to hide this for now and just look at the forecast that I've done. So here is what I would call a conservative forecast for Tencent into the future. Growth rate of around 15% on the top line, even though we've seen 30 to 35% in the previous 5 years. As of 2020, they were growing at 36%. I've gone with 15%, and I know it's conservative, but what I'd like to do here is come up with a conservative judgment as to how fairly valued the stock price is. Now, we're going to go with EBIT instead of net income as our main method of earnings, just because net income includes some unusual items in terms of equity security gains that we don't want to factor in, because although they are happening, they're reoccurring every year, every quarter even. This company is earning a lot from their securities portfolio on a unrealized basis, but it's not something that we want to factor in or think that we can forecast into the future. It's too volatile. Free cash flow, though, is something that we are going to factor in, so we're going to take this as a percentage of EBIT. It's averaged around 125% of EBIT because of the cash and because of the investment income that they receive outside of the operating business. So we are going to calculate free cash flow using EBIT on its historical metrics. And then my terminal value multiple just for the operating business. Remember, this isn't including any of the equity portfolio or equity earnings. We're going to do that on a bottoms-up basis at the end. The terminal value is going to be 25 times, and that's 25 times EBIT, like I said. The reason why I've gone with 25 times and not as low as 20 is because most people are probably valuing this business off of the net income or the free cash flow, which is a lot higher than EBIT. And if we did 20 times net income or a P of 20 times, then we get to a similar amount as 25 times EBIT. So 25 times a fair multiple, I think, especially when it's averaged 37 over the past few years, and we've got 40 times EBIT at the moment. So we're going to say in 5 years, the premium the market is putting on this company is going to trend back down. Anyway, getting to the important part, if we discount all of this back at my required rate of return of 15%, then I get an intrinsic value for the operating business, just the operating business, of $580 billion. Now, that is obviously a bit below the market cap at the moment, but what we need to factor into this is the large equity portfolio. Now, we saw earlier in the video that there was an assumed value for that of around 325 billion, give or take. I think it could maybe even be more than that, but to be conservative, and I know that's that buzzword, conservative, some people don't like it, some people do, but I'm going to be conservative, account for some volatility. If we had a 35% drop in the stock market, especially with the tech stocks they hold, that equity portfolio is going to sink down in value. So I'm applying 250 billion for the equity portfolio, and then that gives us a total value of the business of 831 billion, which the good news is a share price of $85 per share when we dilute that down, and the current price is $79 per share. So we currently have a margin of safety of around 8 to 9%, which isn't bad. Signals that Tencent is undervalued, even if we go with a very conservative 5-year forecast. Now, I've got a slightly better case scenario here. So 5-year forecast, pretty similar to what you've just seen, so I'm not going to spend time running through it. The only change is that we're going 20% on the top line, okay? So they get 183 billion of revenue in 2025. I don't think that's unreasonable for a company like Tencent. We've seen the size of their ecosystem. We've seen how quickly they can grow in the past. I think 20% would be more than fair. Same TV multiple on the EBIT number of 25 times. That gets us to 707 billion as the intrinsic value today for the operating business alone. Add the 250 billion for the equity portfolio, and we get an intrinsic value or fair value for the whole business today of 957 billion, almost a trillion. Now, that is a share price of $99 per share. And if we take the current share price of $79 per share, then that means it's currently 24 to 25% undervalued. You've almost got that 25% margin of safety. And I don't think anyone could say we're being unreasonable in our forecast here for Tencent. So you decide which one you think's more reasonable, which one you prefer to take. Each one says that Tencent is undervalued, and I would argue, after doing all the research I have on Tencent and this bottoms-up analysis, I think Tencent's an undervalued stock. I really do. Now, of course, that's just my opinion. Please don't take it as financial advice and go and buy the stock just because I have said so. But I do think we've got a pretty good opportunity here, and I'm going to be looking into Tencent a little bit more. Of course, you guys know I do own Alibaba. I love Alibaba. Alibaba is the biggest position in my portfolio at the moment. So I may look at Tencent as an addition to the portfolio, but I do probably think that Alibaba is a little bit easier to understand, easier to piece the parts together, and it's probably slightly more undervalued. So if I had a choice, I'd probably be sticking with Alibaba. Now, I'll be leaving this valuation with a little bit of a narrative as well. Both of the valuations, I'll chuck in an IRR calculation as well on the Discord, on the Patreon page. So if you're interested in going and supporting the channel and getting all the various benefits that we have with the Patreon, that includes all of my discounted cash flow models that we've covered here on this channel. You get a copy of them. You can look at changing some of the assumptions, see what stocks you think are at fair value. You can also then take it as a template as well and create your own ones on different companies. We also have a tracking sheet which we've tracked every single stock that we've done here on this channel. We plug in our fair values that we get from our valuation model, and then we track maybe which ones are at the fairest value today and which ones are the most overpriced. So go ahead and check all of those out if you're interested. If not, I'd appreciate if you could just leave a like, subscribe to the channel if you haven't already. I will see you all in the next video. Good luck with all of your investments.